Right now, somewhere in the industrial sprawl of Shanghai, a warehouse manager is staring at rows of metal shelves that once held mountains of silver. Years ago, those shelves carried something close to 5,000 tons. Today, according to current market data, he is down to about 715 tons. That is roughly an 86% decline, an evaporation of metal that once felt impossible. And as he walks those quiet aisles, he knows something even more unsettling is waiting at his desk. 50 industrial buyers, all demanding delivery this month. Some are so desperate that they are reportedly offering to pay extra premiums just to secure whatever is left. In October of the year 2025, China reportedly exported around 660 tons of silver in a single month. Imagine 22 double-decker buses filled with shimmering metal leaving the country, not heading to factories in Shenzhen or Guangzhou, but to London. Why London? Because analysts suggest London's vaults are thinning out, and what we are watching might be the early tremors of a broader breakdown in the structure of global silver supply. A market that usually moves like a glacier suddenly feels like it is cracking from the inside. What fascinates historians and economists is that this pattern is not new. It has appeared 3 times in the past century. Each time, the setup looked eerily similar. Pressure on physical supply, political intervention, financial imbalance, and then a violent upward release in price. In those cycles, silver did not merely rise. It erupted. It doubled, quintupled, and in one extraordinary case multiplied 37 times. These were not random events. They were moments when the physical world collided with the financial one, and each collision reshaped the market for a generation. In 1933, under the weight of the Great Depression, government intervention triggered a sharp rebound. Silver nearly tripled in 2 years. In 1971, when the global monetary system shifted away from gold convertibility, silver accelerated into one of the most dramatic climbs in modern financial history. And in the 2008 crisis, when the global banking system nearly broke, silver rose around 5-fold in just 3 years. 3 different eras, 3 different catalysts, but a rhythm that feels familiar, a rhythm many analysts believe is returning now. I am not a financial advisor. This is not financial advice. What follows is educational analysis, built entirely on publicly available data, but the pace of the current cycle feels different, faster, more compressed, as if decades of tension are being squeezed into a few short years. If past cycles were slow-moving earthquakes, this one feels more like a sudden shift in tectonic plates. Think of it like a game of musical chairs. At first, the music plays, people dance, and everything appears normal. That is the early stage. Then someone quietly removes a few chairs, but no one notices because the music keeps playing. That is stage 2. Then the music cuts. Silence. Panic spreads as everyone realizes there are too few seats. That is stage 3. And then comes stage 4, the desperate scramble. Market watchers say we may be standing right at the moment when the music has just stopped. To understand why, we need to revisit the moments in history when everything changed. Not through dusty textbooks, but by walking through the exact days when governments, banks, and markets collided. On April 5th, 1933, President Franklin Roosevelt signed Executive Order 6102. It was not a polite request. It mandated that every American citizen hand over their gold to the government at a fixed price of about $20.67 per ounce. Comply or face serious consequences. People remember the gold seizure, but what they often forget is what came next. The Silver Purchase Act of 1934. The United States Treasury began buying silver at artificially elevated prices. The reason was simple. By controlling the precious metals, the government could influence the money supply during a moment of national crisis. Silver rose from around 28 cents per ounce to roughly 81 cents by 1935. Almost a tripling in 2 years, driven not by sudden industrial demand, but by a manufactured scarcity backed by government authority. Then comes August 15th, 1971. A quiet Sunday night. President Richard Nixon interrupts American television. With one short announcement, he severs the ability of foreign governments to convert dollars into gold. The Bretton Woods system, the backbone of global trade since the end of the Second World War, ended in an instant. The reason behind the decision was partly fear. Nations around the world had been exchanging their paper dollars for real gold. United States reserves reportedly fell from around 20,000 tons to about 8,000. Something had to break. Once gold began rising, silver followed, moving from around $1.29 in 1965 to about $6.70 in 1974, before ultimately reaching around $48 in 1980. Silver multiplied 37 times in roughly 15 years. Some blamed investor speculation, including the famous Hunt brothers. But many historians argue the hunts were merely amplifiers of a trend that was already building beneath the surface. Fast forward to September 15th, 2008. Lehman Brothers collapses into bankruptcy. Within weeks, the global financial system is trembling. Governments respond with unprecedented liquidity. The Federal Reserve's balance sheet expands from around $800 billion to more than $4 trillion by 2015. Investors searching for protection flee into physical gold and silver. Dealers run out of stock. Premiums spike. Mints cannot keep up with demand. By April of 2011, silver hits nearly $50 per ounce, up from under $9 just 3 years earlier. Another five-fold rise born out of crisis. Now here is the pattern worth noticing. The time needed for each cycle is shrinking. 1933 to 1935 took 2 years. 1971 to 1980 took around 9 years. 2008 to 2011 required only 3. These are accelerations, like watching storms arrive closer together. And the current cycle, which many believe began in 2020 with global money creation, is now entering its 5th year. That places us, historically speaking, at the moment where past cycles began to bend sharply upward. The year 2020 was not just a public health crisis. It was also a monetary event. Governments across the world printed roughly $20 trillion in less than 2 years. At the same time, industrial demand for silver surged. Solar power installations expanded at record speed. Each gigawatt of solar capacity requires around 1 million ounces of silver. China alone installed more than 250 gigawatts in the year 2024, which could represent around 250 million ounces of silver needed for solar panels alone. Electric vehicles consume between 1 and 2 ounces each. 5G networks and artificial intelligence data centers require silver for conductivity. According to the Silver Institute, global solar demand hit around 680 million ounces in 2024. Meanwhile, total mining production was around 813 million ounces, but total industrial demand exceeded 1 billion ounces. That leaves a reported deficit of about 95 million ounces this year. And this marks the 5th straight year of shortage. In total, from 2021 to 2025, the cumulative deficit may be around 820 million ounces, yet prices stayed subdued. Why? Because of the paper market structure. For every real ounce of silver, there may be 100 to 400 paper claims written against it. Large banks reportedly hold massive short positions, selling contracts that promise delivery of silver they may not physically possess. This has long been suspected of suppressing prices, but something changed recently. China, historically an accumulator of silver, suddenly became a major exporter. That 660-ton shipment was not a signal of surplus. Many analysts think it was a response to London running critically low on physical metal. Lease rates in London reportedly jumped from under 1% to nearly 39% annualized, the highest level on record. When lease rates explode, it means lenders fear they may not get their silver back. And then came the sign no one expects in a stable market: air freight shipments of a heavy metal that normally travels by sea because of cost. When companies are paying for planes to move silver, the situation is not normal. It is urgent. By late 2025, the United States government classified silver as a critical mineral. This was not symbolic language. It triggered formal investigations under Section 232, exploring potential import tariffs ranging from 15 to 50%. The timing matters because the United States relies on imports for around 64% of its silver consumption. The moment tariffs become a real possibility, a predictable reaction follows: precautionary buying. Reports indicate that roughly 75 million ounces have flowed into United States vaults since October, as industrial users and investors rush to secure metal before potential price shocks. Meanwhile, China's physical inventories continue to fall. The Shanghai Futures Exchange now holds around 715 tons, down sharply from the pandemic peak above 5,000 tons. The Shanghai Gold Exchange shows about 531,000 kilograms, reportedly the lowest since 2015. These are not abstract numbers. They represent the dissipation of a visible safety buffer that once reassured global markets. Then comes a signal that analysts watch closely: the Shanghai Premium. Recent data shows the spot price in Shanghai trading around $60.30, while New York trades around $58. When physical metal in one region becomes more expensive than paper contracts elsewhere, it usually means the paper market is drifting away from reality. Physical silver becomes more valuable than promises of silver. And historically, that divergence is one of the early warning signs that a financial system tied to metal may be losing its balance. Some analysts insist China may simply unleash hidden reserves, perhaps massive stockpiles sit off exchange. But that story raises a question. If China possessed huge secret reserves, why drain public vaults by roughly 86%? Why export 660 tons in a single month instead of withholding metal for higher prices later? Either the reserves are far smaller than imagined, or they exist but are being preserved for strategic goals rather than profit. In both cases, the global market faces the same problem: physical scarcity. This brings us closer to stage 4 of the historical pattern. Not a crash, not a mania, but a scramble. Today, there are an estimated 800 million ounces of open paper contracts on the main United States Silver Exchange, while deliverable physical inventory is around 40 million ounces. That creates a leverage ratio of roughly 20-1. If just 10% of contract holders demanded physical delivery, the system would struggle to comply. Receivers might be offered cash settlement instead. And when that happens, confidence in the paper side of the market can evaporate quickly. If industrial companies start to worry that they cannot secure metal, we may see the same dynamic observed in previous shortages. Solar panel manufacturers cannot wait months. Electric vehicle supply lines cannot pause. A data center does not run without conductive materials. When shortages become real, these companies will often pay whatever premium is necessary to keep production moving. And if governments sense the shortage escalating, intervention becomes likely. Politicians may launch investigations into manipulation. Export restrictions may be imposed. Paradoxically, each intervention may worsen the scarcity by signaling urgency to the entire market. Some analysts project that silver could reasonably reach between $90 and $100 per ounce by mid-2026. That would represent around a 64% move from current levels. This forecast assumes continued physical deficits and the possibility of United States tariffs pushing prices upward. Larry Leard has suggested targets of $75 by mid-year and $80 to $90 by year-end. Philippe Gelles from BNP Paribas has reportedly argued silver could exceed $100 by the close of 2026. But there is also a more extreme scenario. If delivery failures occur, if export bans take effect, and if investors flood into physical metal simultaneously, some projections suggest silver could surge to between $120 and $170 by the summer of 2026. At first glance, these numbers sound ambitious. But history shows how quickly precious metals can move when trust collapses. From 1979 to 1980, silver jumped from around $6 to nearly $48, an increase of roughly 700%. From 2010 to 2011, it moved from about $17 to around $49, an increase close to 188% in under 1 year. There is another context that is rarely mentioned. The peak silver price of January 1980, around $48, would be approximately $178 today when adjusted for inflation. That means that even at $58, silver has not returned to its inflation-adjusted all-time high. This is part of why many analysts argue the metal may be structurally undervalued, suppressed by decades of financial engineering. So how should a person think about positioning? You do not need perfect prediction, you need a clear understanding of risk and pattern. If you believe China's vaults are genuinely near depletion and that this pattern is completing now, some experts recommend prioritizing physical silver, coins, bars, and allocated storage that is directly tied to real metal. Many suggest avoiding paper funds that may not hold full backing. If tariffs appear likely, securing metal early could avoid steep premiums. If you believe the shortage is real but not catastrophic, a moderate approach may make sense. Diversified precious metals, staggered buying targets, alerts for key breakpoints at $65, $75, and $90. Watch how markets respond to physical stress. If you remain skeptical, that is entirely reasonable. But skepticism does not remove the value of watching signals. Lease rates, exchange inventories, government declarations, Chinese export flows. Patterns do not require belief. They require observation. Of course, many things could disrupt this trajectory. China might release off exchange reserves unknown to the public. Industrial demand could decline if prices spike above $100 and substitutes suddenly become viable. A global recession could lower consumption temporarily. Governments might sustain financial pressure longer than expected, suppressing volatility. These are real risks. But there is a counterpoint that echoes through nearly every historical cycle. Physical shortages do not care about paper prices. If there is no metal available, the paper side of the market eventually breaks. And if the economy sinks, history shows governments often print more money. Crisis, printing, hard assets rising. It is a pattern etched into nearly a century of data. As of early December 2025, silver recently surged to a new all-time high above $59, now consolidating around $58. But price alone is not the most important indicator. China's declining vault levels, record-breaking lease rates in London, the United States designation of silver as a critical mineral, 5 successive years of deficits totaling roughly 820 million ounces, and the strange reality of air freight shipments for a metal traditionally shipped by sea. These are the signals many analysts believe show that we are approaching stage 4. Think again of the musical chairs analogy. We have passed the moment the music stops. Now the crowd is realizing the chairs are limited. In markets, that moment often arrives before most people even look around. You asked earlier which historical cycle this resembles most closely. The truth is unsettling. It resembles all of them. The government interventions of 1933, the monetary transformation of 1971, the liquidity crisis of 2008. 3 different storms converging at once. The question is no longer what might happen. The pattern has spoken before. The real question is whether you will be positioned if it completes.